Can we just talk about the cost component there? Obviously, the AISC just popped up again because you were talking about the tailings facility need lifting, etc. But that was part of the plan. Are you on target to consistently deliver gold ounces at less than $1,000?
Yes. So let's talk about the outlook, I think, for the second half and maybe where we're going for next year, because I think that's, you absolutely, this is critical and was one of our main objectives when we spoke last time, is trying to drive the cost structure down. So, first and foremost, I think everyone should take note that we did reiterate our production and cost guidance for 2020. So we are tracking according to our plan. But without giving quarterly guidance specifically here, I think everyone can do the math. The first half of the year was very heavy production loaded and very low cost because we weren't spending much of anything in terms of sustaining capital. So right now in the third quarter, we're in a very important transition period for the mine. This is the most important 3 months of the mine over the next 2.5 years. Essentially what's happening is we're transitioning out of one of our main pits called Nkran, which we've been mining at for the last 4 years. We finished mining the second phase of ore there at the end of Q2. And we moved out of that pit now and shifted to a smaller satellite pit called Akwasiso. Obviously supporting Akwasiso, supporting where the main driver of production is going to come from now, where we have about 1.5 million ounces of our 2.4 million ounces of resources, the main Asasi pit, where we've been mining now for 1.5 years. So as we've shifted out of Nkran and into Akwasiso, what that means is we're going to be faced with lower grades. The reserve grades at Akwasiso are lower, as they are at Asasi. So we'll be producing between 1.25 and 1.35 gram per ton, along with our reserve grade from those two pits, which means our production levels are going to come down slightly. So if you look at our mill throughputs and our recoveries, we're going to be sitting in that 60,000 ounces per quarter, 240,000 ounces a year. When things go a little bit better, they'll be a little stronger. When they're a little slower, they'll be a little off that, back and forth. But what you can expect basically for the next 2.5 years is production levels around that. And certainly the other important transition here in Q3 is that this is an important quarter for a couple of key sustaining capital expenditures. We are doing a pushback of the Asasi main pit that's going to really benefit us throughout the second half of the year and into 2021. So you can expect stripping costs to be higher there. And importantly, we're finishing up the 5th raise of our tailings storage facility, which started in Q2. But really the bulk of that work is happening in Q3. So you're going to see that Q3 will be certainly our highest all-in sustaining cost quarter for the year. Now we're comfortable, we're still going to hit our guidance. This was going according to the plan, but the nature of the all-in sustaining cost metric, unfortunately, when we do things like stripping, we capitalize it and amortize it from an accounting perspective over the ounces that are open. But for all-in sustaining costs, we adhere to World Gold Council standards and run all those costs through in the quarter they're incurred. So there's some bumpiness in the AISC. So, but having said all that, importantly, when we talked about the life of mine, I think your question, Matt, was where are we heading in our cost reduction strategies? And certainly, we were very keen at the start of this year. We published a life of mine plan that showed all-in sustaining costs over the 10-year period, averaging just over $1,100 an ounce. In our mind, that's too high. Or we set ourselves an objective to be able, and we feel like we can drive the cost structure down to about that $1,000 an ounce level, or reduce the cost by $100 an ounce. It's a big target. The bulk of that was targeted at around from our mining operations, which are contract mining. And we felt we could possibly take 50 cents a ton out of our mining costs, which to put that in perspective, we move about 30 million tons a year. So that's $15 million in savings right there. Now, unfortunately, due to COVID, re-tendering these strategic mining contracts hasn't been as easy as we would have liked. It's really difficult to mobilize contractors into Ghana. The borders have been closed there. Whilst we've been able to keep the mine running and keep the existing contractor going, it's been somewhat challenging running a proper tender process because we're limited to those people who can supply equipment within country. So I think what we're doing is we're working now on sort of a modified version of that. We're really trying to optimize 2021 to capture as much of the cost as we can and trying to drive that mining cost down. But I'd say if we can get between 50 and 70% of those savings for 2021, I think that would be a really good outcome in the backdrop of where we're at currently.